Welcome to the Monday Futures Market Outlook for February 28th, 2011. This is Patrick Ceresna. For those of you that have not had an opportunity to try out eminisource.com's trading room, 5-day complimentary memberships are available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades. We plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles the market has gone through. In 2010, we crossed bullishly above that and remain in trend. And we don't necessarily believe a new bear market will begin, but we do think that somewhere off this 1340 to 1380 area on the S&P, especially after some sort of a topping formation that could develop over the next month or more, we should anticipate some sort of a profit-taking cycle that could see even a 5 to 10, if not even a 15% or more market correction on the downside. That will probably emerge to being a buying opportunity for the next wave, but at this stage we believe we're somewhere near short-term highs. When we take a closer look at the daily charts of the S&P 500, we were looking at that measured move high that came in around that 1340 area on the upside. Since then, we had that very steep, sharp sell-off that was led by the Middle East crisis that found support right at the 1290 to 1300 level. Since this last leg higher, since that low came in right in that zone, right at the retracement zones, we at this stage are now seeing a market that is going to come back up and retest some of the zones on the upside. Where and how high that will go, well, we're looking really at this stage first off right at this 1325 area where we're right now at. That's Fibonacci retracement zone of the sell-off. If the market for whatever reason reversed here, it would open the window for a leg down all the way down to about the 1270 level on the downside. In the same regard, though, if we have anything that forces that market above this 1325 area in the first parts of Monday and Tuesday, well then we'd be looking for a double top retest, which would have that market coming back to its previous highs. There are some measured moves that do target zones around the 1360 and the 1370 zones on the upside. In the bigger picture, while we certainly cannot rule out that the market goes and retests these zones, somewhere up along the highs and going even up to this 1370 area or 1380 area on the upside, where our forecast highs for the year sort of lay, we anticipate there will be topping formations that develop along this upside. But again, that could take weeks, if not a month or more, to start developing in its full form. So really the theme that I would want to put in there is that there's only marginal upside left in the market, but that doesn't necessarily mean a new downtrend has begun. So just to review our key points, we are intermediate bullish on this market, but we are only a few percent away from our upside targets for the year. There continues to be momentum loss, a lack of market breadth, and this rally keeps on going purely on the backs of large cap stocks. We anticipate the market top to lay somewhere in this 1340, 1380 area, but again, it may not suddenly come in within a day. Market tops is a topping formation is a process, not an event, and so what we have to do is recognize that the market's got to keep playing this thing out back and forth. We might find ourselves at the end of March saying the exact same story at the exact same levels. And so we don't want to rush this process and let the market tops develop itself. Next year, I want to take a look at the NASDAQ 100, and the scenario is identical to the S&P. It doesn't need any further explanation. We're looking for this potentially to rally back up to its previous highs if it can beat this retracement zone where it is at right now as we speak. And if not, there's also room for now a move to head right up to the 2450 level where we actually had the target from the last rally that we were talking about. Next here, I want to take a look at the US dollar index futures, and this is actually a very important chart for us to look at because this is where the fuel for the rest of this market rally may very well come. Drawing a little flagging formation that rejected basically at the very bottom of our retracement zone on the dollar index, and we really began another leg lower here, now with a break to a lower low right below that 77 level where the last lows came in. The window may very well really open up for the US dollar to head down towards the 70 76 or even 75 levels on the downside. That would mean that the euro would be heading up to 140, maybe even as high as 142 on the upside. If this breakdown on dollar index really gains any momentum below 77, we could see lows even as low as 74 to 75.50. The key thing that I want to emphasize here, and this is the most important thing for everyone to understand, more than likely the dollar index will be bottoming about the same time as the stock market will be topping. So if this dollar index has a full leg lower, it very well may mean that the S&P 500 is going to still go up and retest some of those previous highs and work its way through that period while we're waiting for the US dollar to finish its move and start basing out a little bit. We anticipate that the lows of the year probably will come in on that dollar index near its previous lows that made back in October, November. But nonetheless, at this stage, the current trend remains lower on the dollar. Next here, I want to take a look at copper futures, and copper has been in a predominant uptrend, and then this is obviously because of the inverse relationship to the U.S. dollar. Again, with that U.S. dollar breaking down, we can't rule out the possibility here that copper not only breaks to its previous highs and goes for a retest around that 465 level, but if we have any momentum on the downside of the dollar and any real momentum in commodities, we could see copper finish its move all the way to the 480 to 500 level on the upside. We're yet to still be bearish on this. If this develops like a head and shoulders formation, reverses off its current level and comes back down, we'll start visiting topping formation ideas. But at this stage, if that dollar index sells, we probably have to look at the scenario that copper still has another higher high to make. Next year, I want to take a look at gold futures, and we had over the last 2-3 weeks a very strong rally that's brought gold all the way back to its previous highs. If gold here makes an attempt to break out to a higher high, it may actually fuel a full leg higher on gold, especially if this is accompanied by U.S. dollar weakness. If we see that U.S. dollar index heading down toward the 74 level on the downside and gold break to higher highs, and we could start targeting 1460, 1480, 1500 on the upside, and that certainly would at least on the short term keep this big picture gold trend bullish. Next year, I want to take a look at crude oil futures, and that we've seen a substantial rally in crude oil as it's moved its way even temporarily above the 98-100 level. But this is where we've seen almost all the major consolidation. We're really at this stage, it's not even as much a technical observation as to whether or not the risk premium is going to be taken out of crude oil if everything stabilizes in the Middle East. If we see anything that resembles stability coming in there, or at least the risk premium being taken out, we could see a very quickly oil head right back down to where it made those previous highs, now the lows around the 91.50, 92.50 area. If though there's any further crisis and there's more money coming into crude oil and the risk premium remains in there, that we could see 108 to 110 on the upside if that goes in there. But it's really hard to anticipate what move will happen there. So many different things can happen on the political front. Next year, I want to take a look at the 30-year Treasury notes, and we had an attempted breakdown on those 30-year Treasury notes back in the early part of February, but subsequently have spent the better part of February rallying back to where all the highs came in around this 122 area. This is a really interesting price action formation, because what it's indicating to us is that Treasury bonds are starting to find their bottoms. That doesn't necessarily mean that a new robust rally is about to begin. Again, I think that will time out a little bit with the US dollar and with the markets, but at least we can start seeing a bottoming formation and developing here on the Treasury notes. At some stage, we're going to have a little bit of profit taking in the Treasuries, probably maybe back down towards the 120 area on the downside, but we may even see the development of an inverted head and shoulders formation along the bottom side, which might make the Treasury notes bullish probably into that April-May period later on, but I don't want to be rushing in to go long these just yet. That was your Monday Futures Market Outlook. Thank you for joining me.